Hey, what's going on? I got exactly what you need to know about what's going on in the housing market today. A lot of cool information, pictures, slides, make it very easy and simple, but all the hot topics and all the influencing factors that affect the housing market. So if you're thinking about buying or selling, I'm going to give you all the information you need to know so that you're comfortable making decisions for your family based on what's really going on, not what you hear in the fear mongering going on social media and on the mainstream media. So let me share a couple slides with you. Uh, I'll move through pretty quick because it's pretty self-explanatory once you understand what is happening. All right, so all right, housing update perspective. So I want to share with you where we are, where we were, where we are, where we're going, and more importantly, why. So you really understand, um, you know, what's happening. So I'll share my opinion of where the market will be in the next few months. It's probably not what you're expecting, but I would love to hear what your opinion is too. And then ultimately, if you have any questions and how I can get you some answers. I broke this up. I have two summary slides for those of you with short attention spans. And then I'm going to break down in detail, not in any kind of lengthy way, but just to kind of explain why we are where we are. So here's the first one. So these are the key housing influencers that I watch so that you don't have to. Um, the market's been reshaped in the last few months. Buyers and sellers kind of recalibrated, took a step back from their moving plans. Um, Buyers are paying $1,000 more than they were this time last year. So, why is that? Okay, so one is inflation. So we were at 8.2% 2 months ago, down to 7.7. The goal from the government is 2%. So we still got a problem on our hands, but hopefully this trend continues. And that goes into the next influencing, which is the next Federal Reserve meeting, which is happening on December 14th. Right. So experts that I'm listening to are expecting probably an increase, but hoping not as much. So we've seen a lot of 75 basis point increases on the Fed funds rate. Um, and hopefully, I'm hearing maybe it's 25 basis points this time around. Okay, so we'll keep an eye on that. But ultimately, what really affects mortgage rates in the housing market is the 10-year Treasury yield. So that was about 3.5% when I checked today. So that's trending down. All right, I'm going to cover this in more detail and what's happening there and why mortgage rates aren't 5% or 5.5% right now. Okay, but getting better. Mortgage rates are getting better as well, and the unemployment rate, 3.7%. Pretty good. Okay, that's one. So then, what are the hottest topics in real estate? Those were the influencing factors of real estate. Um, but here's the too long don't read version for those of you with short attention spans or you got to get back to work. All right. So inventory, still not a great supply of inventory, but for if you're a buyer, more days on market and more options to choose from, more negotiating power. Demand is still there. Plenty of buyers out there. Plenty of qualified buyers if the prices are right. Okay, right now, this time of year, you have plenty of motivated buyers too. If they're out there, they're probably serious. All right, number of sales has been down the last 2 years. This time of year, traditionally, December, Jan, February, slow time of year. I'll share what I think is going to happen in a little bit. Home prices, there's no crash in the cards here based on the data we're seeing. It's going to soften a little bit, may dip a little bit more, especially at the higher price levels, but that millennial generation is strong. There's a lot of demand. They want houses. So that lower level pricing to the median level 3, 500,000, going to stay strong, going to tick up in our local area is what I believe. And mortgage rates, I hope there's some optimistic good news on the way, but we'll see more about that come December 15th or 14th after the Fed meeting. All right, so here's where we get into. I want to cover some of these pictures here, very all graphics. So I'm a very graphic driven guy. I want to see pictures, helps explain a lot and put a lot into perspective. So here, this is homes actively for sale. It's rising, but look at where we were, or look at where we are compared to the 2017, 18, 19 levels. Still way below, 40% lower in terms of active homes for sale. So we still got quite a bit of ways to go here. Right, these are new listings. Okay, this is sellers putting their homes up for sale. Again, look, down 13% from a year ago. And this has been happening for now 16, 18, 19 weeks in a row. All right, so new listings are down, and when you look at them together, you'll see the active listings in blue, and you'll see the new listings in green. Starting in July, that number started to come down, and you see the gap that's happening. So that just means more days on market. So the frenzy is definitely over that everybody was, used to hearing about. Housing supply. If you look at this in any week, I pulled November 4th, compared it to the last 3 years. All right, but each week is pretty much tells the same story. So this week, same week in 2021, 43% more inventory than we had a year ago, 8.5 more than we had in 2020, but still historically low. We're 36% behind where we were in 2019 in terms of homes available for sale. Okay, home price forecast. I'm going to have more on this in the next week or two. More forecasts are coming out, more updated forecasts. This is national level data. A lot of folks still predicting slight appreciation, some predicting depreciation. I think it's going to just average itself out, is the way I look at it. I think locally, we're going to be more on the appreciation side in our market area. Certainly not where we were. So the latest appreciation numbers, this is the latest data that was published. You see less appreciation than what we have seen. The US, house price growth has substantially decelerated. It's been widespread. About a third of all the states in the metropolitan statistical areas registered annual growth below 10%. So that's the latest data, but you can see the same tracked month over month going back to 2021. And you see that average there of 3.8% appreciation, year over year. And you see in blue where we were, and now the deceleration in green based on the latest data that's been published. Okay, so we're heading back to those more pre-pandemic times and normal growth. All right, so have we hit the bottom? In our area, this depends on the price range that you're at. The higher, more expensive homes, I think will come down a little bit more. But that millennial-driven low to medium income or priced homes, I think they're going to stay strong. Okay, this is a look just across the country. 1% depreciation month over month. So certainly decelerating. The hardest hit markets were really out west, and this is what they're experiencing right now. Okay, those are the ones that saw the biggest appreciation, but now they're getting hit a little bit in terms of that trend coming down a little bit. Interesting slide here. As the Fed continues to move interest rates higher and higher, the mortgage financing continues to get more expensive, right? Housing becomes less affordable. So naturally, that's going to result in a little bit of deceleration and maybe depreciation, right? So depending on what you believe, if you pull up realtor.com and you go look at closed sales, um, and you believe we're going to see a 15% depreciation, then look at closed sales in June of 2021. And that's kind of where we'll be at, right? If you believe it's just going to be 5%, then look at February of 2022. And if you think it's going to be drastic, a 25% depreciation in home price values, go back and look at October 2020. All right, so that's a good measuring stick, if depending on what you believe. Okay, and you'll see pre-pandemic 2017, 2020, we were at about 12%, 12% appreciation, and then during or post-pandemic, we were at 38% appreciation. Just a wacky time. We're going to return to more normal appreciation numbers as inflation comes down and as we move forward. A lot of people ask me about foreclosures. So there's three ways that homes hit the market that could fix that supply issue that we've been having. One is existing sales, which we've covered. New construction is the other way. That's been down as well. And the third way is distress sales, foreclosures, right? So these are still near record lows. There's no, indication that foreclosure, that there's going to be a flood of foreclosures coming on the market. Lending standards are still strong. They're still tight. Some believe they're actually tighter, and they're getting tighter. All right, but you see where we were in 08, 09, 2010, and then the lending standards really clamped down, and it's been on a downward trajectory ever since, and we're at about 88,000 foreclosures right now. That'll come up naturally, but not enough to dramatically cause some kind of crash in the market. Right, so mortgage rates, and then we'll wrap it up. Final topic. A return to like the normal spread between government borrowing and home purchasing borrowing rate will bring the 30-year fixed mortgage rates back down to around 6%. Right, so the average spread in a 30-year mortgage, usually these two things move in unison. All right, the 30-year mortgage with the 10-year treasury, and the spread is about 1.7%. Okay, so that being said, on November 19th, we were at 3.7. Today, we're at about 3.4, 3.5% on the 10-year treasury yield. So if it's 3.7, let's say, then that would imply that we should be at around 5.5 or 5.7% mortgage rates, but we're not. We're not. So why is that? So right here, orange is the spread. So this is the difference between rates and the 10-year treasury yield. These are now a dramatic change going on here. So 2000 to 2021, right, you would have had a 3.49 treasury yield, spread 1.79, you'd have a 5.28% mortgage rate. But today, your mortgage rates are 6.61% higher, lower, it fluctuates. But it's because of the spread, the difference in the rate and the 10-year treasury yield. And I believe that's because the investors, the people who buy and sell mortgages and trade mortgages, when there were 2 and 3% mortgages, but now inflation has skyrocketed, it's eaten away at their ability to pay for and service those loans. There's nothing they can do about it now, but what they do is they increase the spread, which is increasing the mortgage rate. So we really got to get that spread down from the lenders, okay? And then if it was normal today, because we're at a 3.7% yield, if we go back to normal spread, we're at 5.49%. And I think we'll get there as inflation comes down and confidence comes up. It'll fix itself. Okay. Some believe actually we will be in the 5% mortgage rate. So what do I think? Listening to some of these experts, Barry Habib and so forth, I believe rates will come down to around 5%. He believes it may even be a little bit lower come the end of the first quarter, come springtime. So I think uh, optimistic that that'll happen. I think inventory is going to naturally increase in April, as it always does. I think home prices are going to start to rise again slightly. It's going to be competitive, right? They're going to dip in price reductions a little bit now, but if you have a presentable home in good condition, there are still multiple offers. Demand's still there. It's not as competitive today, but it is going to get competitive, I believe, in the latter part of the first quarter of 2023. So if you don't want to be in those bidding wars and that competition, now would be a good time. All right, now would be a good time to get into the market. But rates should decrease by then, hopefully. Whether or not you agree or disagree, I would love to hear what you say. Give me a call, shoot me an email, or I will leave a link and you can schedule an appointment in advance just by clicking on the link. All right. So if you have a realtor that shares this type of information with you, then stay close to that realtor. All right. This is valuable information. If you don't, and I'm the one providing this information, let me know. Let me know that you're listening. Let me know if you think it was valuable. Let me know if I'm not covering an area that you'd like to know more about. But I would love to hear if you're appreciating the information, and if you're listening. All right. So shoot me an email, get in touch, let me know one way or another. All right. Thanks for watching, and good luck out there. Happy holidays. I'll talk to you soon.